3 independent systems, 1 week, all crossing thresholds they have never crossed before. COMEX registered silver broke below 80 million ounces, a level never touched in this entire bull market. The LBMA published February vault data revealing its silver to gold holding ratio collapsed below 3.1, unrecorded in modern market history. And simultaneously, 3 of the largest private credit vehicles in America simultaneously gated investor withdrawals, with $585 billion in bank lending as the systemic backstory. None of these 3 signals are being read alongside each other anywhere in mainstream financial coverage. We fixed that today. Every number sourced, every line of math on screen. Tuesday, March 10th, 2026, silver bid $88.43, gold $5.94, gold-silver ratio 59.1, Shanghai physical $13 above COMEX. April 30th, first notice day is 51 days out. Friday, March 6th, 5 vaults, 1 direction. Asahi, 1,269,300 ounces physically withdrawn, not reclassified, removed entirely from the exchange. Brinks, 755,150 ounces reclassified from registered into eligible. Metal stays in the Brinks vault, but the owner has removed it from COMEX's deliverable pool. CNT, 532,446 ounces physically withdrawn. MTB executed both in a single session. 1,084,642 ounces withdrawn, plus 458,644 ounces reclassified. 1,743,286 ounces stripped from deliverable at once. Stone X, 531,345 ounces reclassified out of registered, 5 vaults. 1 Friday afternoon, net registered reduction, 1,745 down 139 ounces. New registered total, 79,988,594 ounces. Historical anchor, COMEX registered peaked at 240 million ounces in 2020. 2/3 of that deliverable pool has since been withdrawn or reclassified. Combined registered and eligible inventory collapsed from 532 million ounces in October 2025 to 346 million today, 35% total system drain in a commodity that requires 7 to 15 years from discovery to first production. The eligible buffer rescue argument fails on its own incentive logic. Converting eligible back into registered during a delivery squeeze releases supply at the precise moment scarcity is most valuable to the holder. That incentive runs directly opposite to what the argument needs. Eligible silver is not a backstop. It is sidelined capital waiting for a price that justifies its surrender. Now attach the May contract to that 79.9 million ounce registered number. 1,281 March, contracts remained open at Friday's close. 405,000 ounces of remaining obligation. Post-March registered projects to approximately 73,583,000 ounces. May open interest, 76,948 contracts. 384.7 million ounces of paper obligation. Paper to registered ratio, 5.2.1. Delivery scenarios are arithmetic, not forecasting. At 10% delivery demand, registered collapses below 35 million before June. At 20%, the request volume exceeds the entire post-March vault. At 25%, the shortfall is 22.6 million ounces, with no in-system resolution pathway. No model needed. Subtraction. The same week, the LBMA published end-of-February vault data. Silver, 27,065 tons. Gold, 9,210 tons. Silver-to-gold ratio, 2.94.1, below 3.1 for the first time in modern market history. The geological frame makes that number alarming. Global mines extract approximately 7.88 ounces of silver for every ounce of gold. The LBMA holds silver at 2.94.1, 63% below what natural production ratios would proportionally imply. Proportional to its gold holdings, London should hold approximately 72,575 tons of silver. It holds 27,065. The 45,500-ton gap does not sit in an undisclosed vault. It is embedded in solar panels, EV systems, and semiconductors, consumed across 6 consecutive years of structural industrial deficit that recycling rates cannot reverse on any timeline relevant to the next delivery cycle. Monthly drain rate, approximately 664 tons. London vaults reach approximately 19,000 tons by year-end 2026 at that pace, without acceleration. One regulatory angle this story demands: Basel III. NSFR rules require banks carrying unallocated silver positions to maintain 85% stable funding against those holdings. That structural cost is actively accelerating the migration from paper leasing arrangements into physical allocation, compressing the LBMA vault from both the demand and supply side simultaneously. In 1980 and 2011, 2 tools broke silver's ascent: Emergency rule changes and consecutive margin hikes. Both have already been deployed in this cycle. COMEX raised margins from 15% to 18%. Silver sold off and recovered. Physical remains tighter now than before that hike. If margin suppression fails again, the final mechanism is cash settlement, the administrative conversion of physical delivery obligations into cash payouts at an exchange-determined price. That is not a resolution. It is a public confession that the physically settled contract can no longer be honored. Shanghai physical silver, $9,500 per ounce. COMEX, $88.43. A $13 premium between two connected global exchanges should theoretically disappear within days. Buy in New York, ship to Shanghai, collect the spread. It has not closed. The physical inventory required to execute that trade at scale does not exist in Western vaults in sufficient quantity. China implemented a silver export licensing regime on January 1, 2026, requiring all exporters to hold a minimum of 80 tons annual production capacity, instantly excluding the majority of smaller producers and traders from the outbound supply chain. Metal flows west to east. The return route is structurally blocked. Landed cost of Western silver entering China, after China's 13% VAT, freight, insurance, and logistics, runs approximately $82 per ounce. That cost floor is the market telling you the structural minimum clearing price for Western silver. The Shanghai premium is not a pricing anomaly. It is a persistent, non-closable signal that futures pricing models cannot incorporate, because those models are built on the assumption that arbitrage operates. In this market, it does not. Last week, 3 of the largest alternative asset managers in the United States simultaneously restricted investor access to their capital. BlackRock's private credit arm received $1.2 billion in withdrawal requests in Q1 2026, 9.3% of net asset value. The prior quarter's withdrawal rate, 4.1%, demand more than doubled in one quarter. The fund distributed $620 million, hit its 5% quarterly redemption cap, and stopped. Investors above that threshold were told their capital is inaccessible until a future quarter. Blackstone's B-Suite, an $82 billion private credit vehicle, received requests reaching 7.9% of NAV. Blackstone raised its cap from 5% to 7% and injected $400 million of proprietary capital to honor all outstanding requests. Firms do not deploy $400 million of their own capital into a fund unless the cost of not doing so is materially worse. Blue Owl went further than both, permanently halted quarterly redemptions and is liquidating $1.4 billion in assets. Apollo, KKR, Ares, and Carlyle declined 5 to 6% in sympathy. The systemic exposure underneath this, U.S. banks extended approximately $300 billion in direct loans to private credit providers. Total banking sector exposure to the alternative credit complex, approximately $585 billion. When 3 of the largest vehicles in that complex gate simultaneously, every bank risk manager is stress testing which lending relationships connect to those vehicles, and what forced liquidation does to the collateral values securing those loans. Bill Eigen at J.P. Morgan Asset Management publicly characterized the opacity and leverage in private credit as concerning. Steve Eisman estimated over 20% of the $1.8 trillion private credit market carries exposure to software buyout loans underwritten before AI disrupted the revenue models those loans were originally priced against. The direct connection to silver. Investors gated out of BlackRock, Blackstone, and Blue Owl cannot access their capital. They hold other assets, liquid assets they can exit without a quarterly cap, without intermediary permission, without counterparty risk. Physical gold and physical silver carry none of those constraints. One gating event is a management decision. 3 simultaneous gating events across the 3 largest names in the sector is a systemic signal. The macro environment compresses every one of these signals further. The Dow fell 361 points Monday, oil trading above $100 per barrel. The standard inflationary playbook, Fed tightens, dollar strengthens, silver faces rising opportunity cost, is not executable here. With $585 billion of bank lending connected to a simultaneously gating private credit complex, raising rates aggressively risks converting a gating event into a default cascade. Monetary paralysis. Silver's industrial demand does not pause for monetary paralysis. Solar installation programs are 20-30-year infrastructure commitments. EV procurement contracts lock silver specifications at the engineering level years before delivery. What monetary paralysis changes is the investment premium, and it moves higher the moment institutional confidence in the unconditional liquidity of paper claims begins to visibly fracture. 3 simultaneous gating events, named institutions, specific dollar figures on the public record, are exactly that moment. The complete picture, as of Tuesday, March 10th, 2026, COMEX registered 79,985.94 ounces. May open interest, 76,948 contracts, 384.7 million ounces of paper obligation. Paper to registered ratio, 5.2.1. LBMA silver, 27,065 tons against 9,210 tons of gold. Ratio, 2.94.1, below 3.1 for the first time in modern market history. Monthly drain, 664 tons. Private credit, BlackRock, Blackstone, and Blue Owl simultaneously restricting capital access against $585 billion of total banking system exposure. Shanghai, $13 per ounce above COMEX with no functional arbitrage pathway to close it. 4 independent systems, 1 convergence point, 1 timeline. COMEX registered was 240 million ounces in 2020. The LBMA ratio was above 3.1. Silver at $88.43 is priced for none of this. April 30th is first notice day for the May contract. Every contract holder faces the same 3-way decision: roll to July, close the position, or stand and demand physical delivery. If delivery demand exceeds the registered vault, COMEX has exactly 3 resolution paths. Path 1, eligible to registered conversion. Eligible holders have every structural incentive to hold. Overcoming that incentive requires a cash premium significant enough to justify early surrender, which implies a substantial move above current spot before a single eligible ounce enters the deliverable pool. Path 2, emergency sourcing from London. The LBMA is draining 664 tons per month and just broke a historic threshold. Any meaningful transfer of London metal to New York directly accelerates a vault already in structural crisis. Path 3, cash settlement. The administrative conversion of physical delivery obligations into cash payouts at an exchange-determined price. In every historical case where cash settlement was imposed on a physically settled futures contract, the LME nickel event of March 2022, where nickel spiked from $29,000 to $101,000 per ton in 48 hours before trading was halted and contracts voided, the price response was immediate, severe, and not expressed in percentage points. The registered vault does not rebuild on its own. The LBMA ratio does not self-correct. April 30th, 384 million ounces of paper obligation, 73 million ounces of deliverable metal. First notice day. One word in the comments: bullish or confused. If you understand what $585 billion of banking exposure to a simultaneously gating private credit complex means alongside a 79.9 million ounce COMEX registered vault and a sub 3.1 LBMA ratio, subscribe. Every number in this video is sourced and verified. This is the Asian guy. This content is for educational and informational purposes only. Nothing in this video constitutes financial advice. Precious metals markets are volatile. Always conduct your own due diligence before making any investment decisions.